Hey everyone, Chris Stearns, Thrive Financial here. Wanted to hop on today and discuss an interesting product that I'm getting a lot of questions on, and that is a temporary buy down loan, sometimes called a 2-1 buy down. There's also 3-2-1 buy downs, and there's some misnomers on how this product works. So I wanted to hop on here and show you kind of the positives, the negatives, and how people are using them to get lower payments. So I'm going to share my screen here, and we're going to go over some stuff on the 2-1 buy down. So first thing I want to talk about is just how a 2-1 buy down works, right? Or a temporary buy down loan. It is a 30-year fixed mortgage. It's not an adjustable product, but it starts with a rate that is lower in the first 2 years than what the end rate on the loan will be. So in the scenario I've laid out here, you've got an $850 purchase at 20% down with a going rate of 6.5% today. I'll show you in a little bit. That's an actual rate you can get on this mortgage today. So with a 6.5 rate on an $850 purchase at 20% down, principal and interest you'll see here is about $42.98, almost $4,300 a month. With taxes and insurance, you're looking a little over $5,200 a month in total payment here, right? Now, this is what you will qualify off of. So you do need to qualify off of the end rate, which is important. And the other thing is you need to be comfortable long-term with this payment, okay? Because what's going to happen is with the first year in a 2-1 buy down, we're not going to give you a 6.5 rate. We're going to give you a 4.5 rate. That's going to drop that total monthly payment with tax and insurance to $43.49. Now, you'll remember a second ago I was showing you a $5,200 a month payment. So the idea with this product is you get a lower payment in the first year, a slightly lower payment in the second year, and then you get your fully amortized payment starting in year 3 all the way through year 30, or as long as you're in this loan until you pay it off. So it is attractive to buyers in this market with interest rates up because you've got this lower payment here, but you can't get comfortable with this lower payment. This is only going to last for a year. So the 2-2-1 buy down means that for the first year in that mortgage, you're 2% lower than the actual final note rate. Then starting in month 13 for year 2 of your mortgage, you're going to go from 4.5 up to 5.5. So that'll take that $43.40 payment up to $47.65. So you're going to step up a little bit on that payment. Then when all is said and done, you're going to end up ultimately, unless you refinance it or pay it off before then, at that 6.5% rate and that $5,200 monthly payment. So what I don't like about this product is you have a lot of loan officers and agents selling this product right now as you have this attractive lower payment. But if people get used to that payment, they can get some payment shock in years 2 and especially in years 3 and possibly not be comfortable with the end monthly payment. So when I'm talking to clients about a 2-1 or a temporary buy down product, I'm always going to start here with the fully amortized payment because I want to make sure that my clients are good long-term in this product. Okay. Now, let me tell you a little bit how it works. So the way it works is they're going to take all of the interest savings. You have to pay that up front. It's not just free money. Okay. So in this specific scenario, first year interest savings by having 2% lower in rate comes out to a little over $13,600. Your interest savings in year 2 comes out to about $6,800 because obviously you're only 1% lower than final rate. So you're saving over $20,000 in the first 2 years on monthly payment. But again, it's not free money. So the way it will work is that money needs to be put into an escrow account or an impound account when you fund your loan. So when you bring in your down payment, your closing costs and things like that, you're going to have to bring in the money for the buy down product because the bank still needs to get their interest on the loan. Now, the way a lot of people are structuring this right now is they're getting seller credits. So we've kind of seen a shift in the market a little bit. We've been in a major seller's market over the last few years, and now we're starting to see it even out or possibly even push into a bit of a buyer's market because there's not as many buyers out there with the high interest rates. They're not willing to pay, way over asking price, and they're not willing to go in with no contingencies and things like this. So we're seeing sellers finally kind of in a more normalized market give some credits for closing costs, give some credits to buyers to help buy down their interest rate. And that's where we can use this. So if we're able to get, 10 or 15,000, maybe even $20,000 in seller credit, rather than the buyer taking additional down payment funds and putting them into this temporary buy down account, we can now have sellers contribute to that account. And then it's truly interest savings for our buyers, right? Because we have the sellers paying for this temporary buy down, goes into the impound or escrow account. And then after 2 years, the payment normalizes. Now, if you were to pay off the loan before then, whether it's refinance, sell the property, more likely refinance, right? any monies that are in that impound or escrow account actually get refunded to the buyer. So there's no negative to, we're using temporary buy down, and then all of a sudden, oh, rates are lower a year from now, we're refinancing and we're losing all this money that was contributed as a seller credit, or that we possibly ourselves even put into this temporary buy down impound account. So that's the way the product works. For the right buyer, I do think it's a great product right now. Again, you need to have the money in that impound account. I don't think it makes a lot of sense to fund it yourself, because there's no real interest savings there, right? You get used to a lower payment with money that you already funded up front, that $20,000, and it makes it so there's higher cash to close your purchase transaction. But if you can get a seller to credit for a rate buy down towards closing costs, essentially, and use their funds to fund this temporary buy down account, I do think it's a viable product. Now, the reverse side of this coin is a permanent buy down, right? So a permanent buy down is just paying points on your loan, is what you'll probably hear a lot of people talk about it. So I'll give you an illustration here. Here's today's rates on a 30-year fix for this exact scenario. You'll see we have a 6.5% rate here. When you see in the green, these are seller credits. In the red, these are points, right? So in order to spend roughly $20,000 on this scenario today, oops, sorry about that. You're looking at somewhere between 6.25 and 6 1/8. 6 1/4 would cost you $17,000 today. 6 1/8 would cost you $23,800 today. So you'll see if you're getting this seller credit somewhere in the neighborhood of $15,000 to $20,000, it's going to go a lot further on the temporary buy down product. Now, albeit this scenario here buys down the rate forever, right? You just get the lower rate. You get the 6 1/8, you get the 6 1/4. With the temp buy down product, or the 2-1 buy down, you're getting 4.5 for an entire year, which saves you $13,000 worth of interest. And you're getting 5.5 for a year, which is saving you an additional $6,000 worth of interest. The reason we like the temp buy down product right now a little bit is because we're expecting interest rates to go lower in the next few years, right? Once we get inflation under control, you should see lower interest rates. And at that point, it's going to open up an opportunity to refinance. So again, for buyers paying their own temporary buy down, I don't really love that product. Even buying down your rate permanently right now, I'm not crazy about for buyers, just because I do think we're going to see lower interest rates in the next couple of years. We'll refinance a lot of the people that are purchasing homes right now. And if you pay a bunch of money out of your own pocket to buy down that interest rate, that's money wasted as soon as you refinance, right? Because you haven't recouped that in interest savings. Or on the temp buy down product, or even the permanent buy down, if you can get the seller to contribute and do the buy down for you, it can get you a lower payment for a number of years, or for this scenario, for the life of the loan, and really help buyers have a little less payment shock when they're getting into properties. And again, just want to stress the caveat. It is nice, but they have to be ready for this payment long term, right? Because by year 3, 2 years, their second year anniversary of closing the loan, they're going to be at this full amount of payment, right? So if they get used to a $4,300 or a $4,700 a month payment, and all of a sudden they bump up to $5,200, that can affect a lot of buyers' budgets, right? So again, if you're selling this product to your clients, especially when I'm selling it to my clients, I'm always going to stress, we don't know interest rates are going to be lower in the next 2 years. We think they will, and there will be a good opportunity to refinance, but I'll never guarantee that for my buyers. So please make sure you are ready for this full 6.5% payment, the $5,200 a month. And then if we can get the seller to fund our temporary buy down, we can save some money in the short term on interest, have a lower monthly payment, and then hopefully refinance before then. So hope this was useful for you guys. Hope you guys enjoyed a little bit of information on what a temporary buy down is, a 2-1 buy down. There's even a 3-2-1 buy down product that's a little bit more aggressive. If you have any questions on this product, you want to be educated a little bit more, or look into possibly getting pre-approved, feel free to give me a call. Again, it is Chris Stearns at Thrive Financial. Hope you have a great day.